Hello students, this is Professor Faiz Raut from Jain College of Engineering Department of MBA. I'm teaching subject Legal and Business Environment. I'm in Module 4, Part 4. Well students, this is the last part of Module 4. In this module, I'm going to teach about national income. What is national income? What are the different components which are involved in calculation of national income? How the measurement of national income is done? What are the different ways in which this national income can be measured? And also I'm also in this part there is discussion regarding components of GDP, okay, gross domestic product. Well, you might be very familiar with this term as GDP is the measure which has been very oftenly used in calculation of the economic situation of countries. Okay, so let's begin with this module. First is, what is national income? National income is the sum of money value of all the final goods and services produced in a country over a period of time. This period of time is generally taken as 1 year. So whatever the goods and services are produced, their final value, not the work in progress goods, the final goods and services which are produced, the money value which has been derived, that is being considered under national income. And this money value means the current price of these goods and services. And in all the cases, while measuring national income, only final goods and services are taken into account, not the goods and services which are still work in progress. This national income takes into account three things. There are three components, you can say, of this national income. First is gross national product, GNP, gross domestic product, GDP. Third is net national product, NNP. Okay, let's go and discuss some few points about these three. Gross national product, GNP. GNP is calculated as all the final goods and services which are produced within the boundaries of the country. So within the boundaries of India, whatever goods and services, final goods and services are produced, those are taken. The money value of all these are taken and added together, and along with this, the NRI's income are also considered. Whatever the repatriation amount, whatever the money which the NRIs are sending from outside India to India, that is also considered as the income of the country. And in this thing, we are subtracting the foreigners' income. The foreigners' income means the foreigners who are in India, whatever they are earning here, that income is being subtracted from GNP. So GNP, the formula goes, the final goods and services produced in 1 year within the boundaries of the company plus the income which is sent by the NRIs to India minus the income which is being earned by the foreigners in India. So by this, we can say GNP is equal to GNI. The gross national product is equal to gross national income. Next one is gross domestic product. Gross domestic product is the formula, if you see, is quite similar with GNP, but a small rather a major difference in this formula is GDP is equal to final goods and services which is produced within the boundaries of the country in a period of 1 year, but we are subtracting this with the NRI income which is coming from outside, as this income is not produced in our country. It is not the domestic produce, it is the foreign produce, but it is coming to India. So this income will not be considered here, that will be subtracted, and the income which is being earned by the foreigners who are residing in India, that will be considered, as that income is being produced in the domestic region of India. So GDP formula goes like this: final goods and services produced within the boundaries of the country in a period of 1 year minus the NRI income plus the foreigners income who are residing in India. This is about GDP calculation. The last one is NNP, which is net national product. Net national product is simply the gross national product minus the depreciation. So whatever gross national product we have calculated, we are subtracting depreciation from it. Depreciation is very similar to what you have studied. It is that part of total productive assets which is used to replace the capital worn out in the process of creating GDP. Don't worry about this statement if you don't understand. Depreciation is basically what the machinery or whatever we are using while manufacturing all the products in the country or services in the country. The depreciated amount, the worn out amount, will be subtracted from the gross national product, and we will get net national product. So these are the three types of components of calculation of national product. Well, there are many approaches. These are the three approaches which are generally being considered while calculation. Most often is GDP is used, but there is in-depth analysis of how to calculate this national income. We are going to see this. Measurement of national income. National income may be measured in three different corresponding methods: net product method, factor income method, and expenditure method. In this three method, all the above three components are included somehow. Okay, so I'll begin with the first one, net product method. Net product method is the net product method is also called the value added method. This method consists of three stages. First, estimating the gross value of domestic product. Second, determining the cost of material and services and depreciation. Third, deducting these costs and depreciation from gross value to obtain the net value of domestic product. We'll discuss these three stages one by one. First is estimating the gross value of domestic product. In this step, the output is classified under various categories on the basis of nature of the activities from which they originate. Okay, for example, agricultural activity will be segregated, the manufacturing activity will be segregated, the services industry and the services activity will be segregated, and in that also many classifications will be done. And after classifying all these, the value of gross output is computed into two alternative ways. First is by multiplying the output of each category of sector by its respective market price. Second is by collecting data about the gross sales and changes in inventories from the accounting of manufacturing enterprises and computing the value of GDP. So basically in this method, in this step, we are classifying the output under various categories in the various sectors, and then we are using this gross output and we are calculating this gross output by these two, A method and B method. Okay, the next step goes determining the cost of material and services and depreciation. So in the first step, we have calculated whatever income we have generated in the period of 1 year. Now in the second step, we are determining what is the cost of material which is being used to generate that income. So this step goes like this: estimate the cost of production including depreciation. The costs are estimated either in absolute terms or as an overall ratio of input to output, input to total output. Okay. And that means exactly whatever the cost is involved in the monetary terms, that is taken in absolute terms or as a ratio of input to output is been taken to find out the cost. And traditionally, depreciation is estimated as some percentage of capital permissible under tax law. So how we calculate depreciation in accounting, the similar way the depreciation will be calculated in this. The final step in this method is deducting these costs and depreciation from gross value to obtain net value of domestic output. Deductible costs including depreciation are estimated for each sector. The cost estimates are then deducted from the sectoral gross output to obtain the net sectoral products. So in the first step, we have calculated what are the income from different sectors. Second step, we have calculated what is the cost of manufacturing those goods and services. In the third step, we are deducting these costs along with depreciation from the income. So by this we are getting the net sectoral products. Then these net sectoral products are together added, and net national product or national income is obtained. Okay, the second one is factor income method. This is quite interesting. This goes, then national income is calculated by adding up all the incomes accruing to the basic factors of production used in the product producing the national product. That means whatever income is being generated, okay, not the monetary value of the products and services, but the income which is being generated, this will be considered. The formula goes like this: net income is equal to rent plus wages plus interest plus profit. The total factor income are grouped under three categories: uh, income, labor incomes, capital incomes, mixed incomes. Labor incomes, wages and salaries paid to the residents of the country, including bonuses and commission. Supplementary labor incomes, including employees' contribution to the Social Security and Employees Welfare Fund and direct pension payment to retired employees. Supplementary labor incomes in kind, that is free health, education, food, clothing, and accommodation, etc. So basically, all the income which is being earned by a labor in terms of wages, salaries, or any additional benefits in terms of monetary or in terms of health, education, accommodation, any kind of income, everything will be considered under labor income. Second is capital income. Capital income is whatever the dividends, the profits before tax of the corporations, the interest on bonds, mortgages, saving deposits, net interest paid by the commercial banks, rents from land, buildings, royalties, a profit of government enterprises, all those things which are considered in the monetary value are considered in capital incomes. Next, the last one is mixed income. Mixed income, we cannot if we cannot segregate into labor or capital, we consider these activities under mixed incomes. Mixed income comprises of farmer enterprises earnings, sole proprietorship earning, so and earning by other professional like legal, lawyers income, or medical practices, consultancy services, trading, transportation. All these are considered under mixed income, because we cannot consider a lawyer as a labor, okay, or nor we can consider his income as the capital income. So the income of lawyer, a doctor, or any consultant during trading or transporting, all these incomes are considered a mixed income. And all the three kinds of income, labor income, capital income, and mixed income, are added together, and finally we'll get the national income by this method. Okay, the next method is expenditure method. By calculation of national income by expenditure method is very well accepted by many countries in the world. It is also known as the final product method. It measures the national income at the final expenditure stages. There are two methods in estimating the total national income, total national expenditure. First is all the money expenditures at market price are computed and then added up together. The value of all the products finally disposed of are computed and added up to arrive at a total national income, total national expenditure. Let's see these two. First, all the money expenditure at market price are computed and added up together. All, all the private consumption expenditure, direct tax payments, payment of non-profit making institutions and charitable organizations like schools, hospitals, orphanages, any private savings. So all this expenditures are taken at market price. Okay, whatever, this expenditure method is basically saying whatever expenses the population of that country is doing, all the monetary values which the population of the country is spending, all these things will be taken and then added together to find out the national income. Okay, second point is the value of all the products finally disposed of are computed and added together. In this, private consumer goods and services, private investment goods, public goods and services, net investment abroad. So once a product is being the raw material of a product is being taken, it is being traded to a company manufactures that product. That product comes to a wholesaler shop maybe, and then to a retailer shop. Then the consumer will buy that product. Then finally that product will be disposed of. So whatever the price, the monetary price of that product is, mm, for the consumer, that is considered in the calculation. Okay, so this was one of an example. So whatever expenditure the population of the country is doing, that amount will be added together and national income will be found out. And in this expenditure method, this above method, the value of the products finally disposed of are computed and added, and then added up, are being extensively used, because we can find out the data very easily. What are the prices of the products, final products, the retail MRP prices of the products can be easily calculated, and with ease and accuracy. So this is generally used. The previous method of expenditure method is not that much used. This method is very difficult to find out, whereas this is quite easier to find out the value of the products and services. Okay, so these were the three methods in measurement of national income. Next, I come to components of GDP, and this is the last part of this module. Gross domestic product, there are four major components. First is private consumption expenditure, investment expenditure, government purchases of goods and services, and net exports. Net exports means whatever we are exporting minus the imports. Okay, this value can be negative, this value can be positive. In the case of Indian economy, generally net exports are in the negative value. Okay, so let's begin with the first one. Private consumption expenditure. This component measures the money value of the consumer goods and services which are purchased, classified into consumer durables, semi-durables, non-durables, and services. Private consumption expenditure includes expenditure on all these categories of goods and services. So private consumption expenditure takes into account all the money value which is being spent on consumer goods and services. Okay. Second is investment expenditure. Investment means addition to the physical stock of capital during a period of time, and investment includes building of machinery, housing, construction of factories, offices, and additions to a firm's inventory of goods. Intermediate goods are used up in the process of making other goods and get partially depleted. Like if we are manufacturing a building, then we are using many machineries to manufacture those buildings, and those machinery will be worn out. So that will be subtracted from calculating the investment expenditure. And finally, net investment is obtained by deducting depreciation value from gross investments. So investment expenditure is whatever money is being spent on investment, on physical stock which has been added in the economy. Okay, that stock is not yet sold, but it has been produced. Okay, the expenditure to produce that stock, to produce machinery, or to produce or to construct a house, or to construct a factories, all those things, expenditure for that is considered under investment expenditure. Third is government purchases of goods and services. This component summarizes government spending on goods and services. It includes purchase of intermediate goods and wages and salaries paid by the governments. So whatever the spending of government is there in the economy on goods and services, all those things are considered. And finally, net exports. It shows the difference between domestic spending on foreign goods, that is imports, and foreign spending on domestic goods, that is exports. So net exports is basically exports minus imports. I believe you know what is exports and imports. Well, exports consist of all those goods and services which are sold basically to the consumer outside the countries. So if we are exporting rice, that means we are selling rice to some other country, and if we are importing something, that means we are buying something from outside the countries, which is the requirement in India. So we export gems and jewelries. Leather is the maximum chunk of export from India. So leather exports are very high. Gems and jewelries exports are very high. Agricultural products exports are very high. Whereas imports, India is a huge importer of crude oil. It is among the top three or four countries which import the crude oil. So the requirement of crude oil is very high, and as per my knowledge, exports minus import is always negative from past many years in India. So the next net exports calculation in India is always negative. So if you see the trade deficit, the term is used for this. Trade deficit is always negative for India. Okay, okay. So coming back to this, we have calculated all the four components, and finally the GDP is calculated like this. The gross domestic product is the total value of sum of the consumption expenditure by the households, investment expenditure by the firms, government purchases, and net exports. So all the things are being added and we'll get the amount of GDP. And this GDP is in the monetary terms. And in the news channels, what we hear GDP is 6%, is 7%. That is the GDP growth as compared to the previous years. So this completes our fourth module, and I'll begin with the fifth module shortly. Thank you for listening.